Hello and welcome to Cordium's webinar entitled Why Malta for UK and US Fund Managers. There will be some time at the end of the presentation to answer any questions. You should be able to see the questions area on the GoToWebinar console as you have here on this slide. You can submit your questions through the GoToWebinar application. If we don't have time to answer all the questions, someone will respond to you directly via email. Today's webinar is hosted by Adam Domenico, Chief Executive Officer of Cordium Malta. Guest speakers will include Anne Healy-McAdam, our private client tax partner at Cordium, and Andre Zarafa, partner at Ganado Advocates here in Malta. Adam will now give a brief introduction to Malta. Adam, over to you.
Thank you very much. Good afternoon to all, and actually good morning to some of you calling in from the US. Today we are going to cover three main angles. The first being the non-dom aspect. There's been a lot of noise in the news with the changes in the rules for non-doms, and we're going to touch upon the benefits from setting up an AIFM in Malta for non-dom owners of asset managers. We will then lead into the next section on Remuneration Code stemming from the AIFM directive, and once again mention how Malta may benefit UK and US asset managers. Finally, we'll touch upon Malta fund vehicles to give a flavour of the different type of fund vehicles one can set up in Malta. Before that, I'll just spend a few minutes introducing Malta. So leading right into it, a brief introduction on Malta for those of you that may not have been here. Malta, as you can see on the slide, is a small island. It's in the Mediterranean, very well placed, so a lot of history. It's a 3-hour flight from London and very well connected to the mainland. The Maltese law is a hybrid of English common law and civil law. Malta itself, as you can see on the slide here, is an EU member state, which we'll touch upon later in the slides. Very important also when setting up in a jurisdiction outside of where you may be, to note that business here in Malta is generally done in English. So the working papers are in English, the MFSA rules are in English, the legislation is in English. So it's important to take that into account. We have quite a skilled workforce, predominantly accountants and lawyers. One thing to mention as well is the pro-business approach of the regulator, the Malta Financial Services Authority, MFSA for short. They have an open door policy, and we have been through this many times where clients would fly down to Malta, want to meet the regulator, and with a couple of weeks' notice, we tend to be able to get them in front of the regulator, and typically they are very impressed by having that facility, putting a name to a face, which could be used for, obviously, the case approach for the application, but also post-license to be able to know who to speak to if and when there are issues to discuss. The same would apply from a pro-business approach for the government. They tend to obviously believe in financial services generally because it's one of our pillars of the economy and it's growing steadily, and hence we always have support from the government. The next slide 7 just shows us some statistics on the industry in Malta. The slide speaks for itself. However, good to point out that we have approximately 600 funds and a growing steady number of asset managers, as you can see on the graph, up to approximately 150 recently, and also showing a steady increase over time. It's important to know that whereas the growth shows itself, however, we don't have a huge growth here, which is a good thing because prices and costs are being kept down, which is also one of the aspects of setting up in Malta, which we'll touch upon later in the slides. Some of the points that I may not have mentioned already of why set up in Malta, be it a fund and or a manager or advisor as used in the US. From a fund's perspective, we already mentioned that there's a growth in the fund sector, which is always important because service providers invest in themselves to be able to facilitate the services required by yourselves. Malta was ranked as the most favored European domicile, which is good. We mentioned Malta being part of the EU. You can set up various structures, as Andrea will touch upon later in this presentation. We mentioned service providers already, and I touched upon the cost aspect. So just mentioning it again here, both the setup costs and the ongoing operational costs for a fund and also for a fund manager below are significant here in Malta, not to be ignored. Similarly, from a manager perspective, the EU, the fact that we are part of the EU, setting up in Malta will allow you to get the EU passporting rights and hence be able to market your fund across Europe. There are also other benefits which we will touch upon in the next section and that after, and those include tax benefits for both the corporates as well as the non-dom aspects, which we'll touch upon shortly, as well as the Remuneration Code, which we'll again get into in the second section. We'll now jump into the main body of the webinar, starting off with the non-domiciled aspect. Typically, from what we have seen over the years for asset managers being set up, this type of benefits is relevant to individuals who are either currently own or intend to own an asset manager. Obviously, they are not domiciled or deemed domiciled in the UK, and are currently managing in excess of 200 million or expect to manage in excess of 200 million. I will now hand over to Anne to take us through to the non-dom specifics.
Thank you, Adam. My name is Anne Healy-McAdam, and I'm the private client tax partner at Cordium in London. Today I'm going to speak to you about domicile, as Adam mentioned, it has been in the news in the UK rather a lot recently. Domicile is a concept of international law, and it's used to tie a person to a particular jurisdiction. The UK have extended its meaning, and they use it for tax purposes and offer UK resident non-domiciled individuals preferential treatment for the taxation of their foreign income and gains. So let's explain what it is. Domicile is where you consider your permanent home to be, not necessarily where you're living at a particular time. At birth, you acquire a domicile of origin from your father, and this domicile of origin will stay with you throughout your life until it is displaced by a domicile of choice. In order to create a domicile of choice, you must abandon all ties with the state where your domicile of origin was, and you must be resident and set up a permanent home in the new jurisdiction. If at a later date you then leave that jurisdiction where you're clinging to the domicile of choice, your original domicile of origin will revive. The third kind of domicile is a domicile of dependency, and that basically affects children who are under 16 years old. So when you're a child, if your father moves his domicile, your domicile automatically moves with you. And also, married women prior to January 1974 used to take on the domicile of their husband when they were married. For tax purposes, in the UK, the scope of domicile has been extended to include both deemed domicile and the ability to elect to be deemed domicile. One might question why anyone would ever want to be UK domiciled, and that really arises on death when one party to a marriage does not have the same domicile as the other, because it's preferential in the UK for both spouses to have the same domicile, and certainly where one person is UK domiciled and wishes to make a transfer to a non-domiciled person, there are very tight restrictions on the amount of free transfers that may be made. However, looking at our slide, changes to the taxation of non-noms, in the current position, which I'm calling the old rules, a person became deemed domiciled in the UK when they had been resident in 17 out of 20 tax years. When this occurred, they became deemed domiciled for inheritance tax purposes only. This meant upon their death, their worldwide assets would be subject to the UK inheritance tax laws. New rules are coming in from 6th of April next year, which says that a person will become deemed domiciled when they have been resident for 15 out of 20 tax years, and this will now count for all taxes. Therefore, a person who is deemed domiciled in the UK will be subject to tax on their worldwide income and gains. We understand that from April 17, people who become deemed domiciled on that date will have the opportunity to rebase their foreign assets, possibly to market value on that date, but at the moment we are awaiting legislation. There have been a number of elections in the UK at the moment, therefore we are currently in a state of purdah, which means that the Revenue are not able to let us have any draft legislation until probably November of this year at the earliest. You should bear in mind that when you're counting 15 out of 20 tax years, it is residence in any part of the tax year. So you could actually, if you choose the wrong day, if you arrived in the UK on the 5th of April, you could actually become deemed domiciled after being resident for 13 years and 2 days, if it's the wrong 2 days. If you become deemed domiciled, you will lose the remittance basis of taxation, which is what is very favourable. There are other changes from April 2017 in that place of birth is now going to be important, which is a new concept in the UK, which means that if a person has been born in the UK with a domicile of origin, if they have gone abroad, say for 20 years and lived abroad and made a career abroad, if they return to the UK after April 17, they're going to be automatically deemed domiciled from the beginning of that tax year. This means that typically, with a person who has gone abroad for a long time, if they have set up family trusts whilst outside the UK, when they return to the UK, legislation is going to be introduced that will basically look through those trusts, which means that a returning UK domiciled of origin individual will now be taxable on any tax planning that he undertook in the nature of trusts whilst non-resident. Other individuals who are deemed domiciled will still benefit from the rules with trusts prior to becoming resident in the UK, and they will not be looked through. As I said, the benefit of being UK resident but non-domiciled is the ability to claim the remittance basis of taxation. In certain circumstances, UK resident non-doms can choose how their foreign income and capital gains are taxed. Either the worldwide income and gains basis, which we call the rising basis, or the remittance basis, which means that you are only taxable when you transfer income or gains into the UK. It is possible to jump in and out in different tax years, so that one year you may claim the remittance basis and pay the tax charge for this benefit, and the following year you may decide to simply go on the rising basis if you have not had any large transactions outside the UK. The effect of the remittance basis claim is that all of your foreign income and capital gains are not taxed unless they are remitted or enjoyed in the UK. Enjoyment in the UK, as I've said in the slide, it's a bit more wide than you'd expect. So the use of a foreign bank account, debit card or a credit card in the UK will be treated as a remittance of the income that you have spent in the UK. Similarly, since August 2014, any new loans that have been taken out against foreign assets will be treated as remitting that foreign asset, and there may well be a tax charge if income is in the structure. The remittance basis claim, as I said, there is a charge for this claim in certain circumstances. You claim for a particular tax year, which means you don't have to claim every year. In the first 6 years of being resident in the UK, there is no charge for claim remittance basis. When you have been resident for 7 out of 9 tax years, you will pay £30,000. 12 out of 14, you will pay £60,000. And for this year only, if you've been resident in 17 out of the previous 20 tax years, you will pay £90,000. Obviously, with the new rules coming in April 17, that will no longer be appropriate. The claim itself is made on your self-assessment tax return, on the domicile and residence section, and you simply pay the charge along with any income tax or capital gains tax liability in that tax year. So, as you can see, a UK resident but not domiciled individual has the ability to retain his offshore income and gains and keep them outside the scope of UK tax unless they are remitted to the UK. With careful tax planning, such an individual can choose when to pay the RBC or make effective years where they can benefit the most. Over to Adam now.
Thank you, Anne. So, having heard the non-dom aspect and the rules and the upcoming changes, which again I understand in November, hopefully we'll learn more, how does that really apply to an AIFM being set up in Malta? On your slide here, we start off with tax efficiencies. And essentially the typical structure that we are used to here in Malta over the last few years is essentially the individuals, the non-dom owners on top of the slide here, will own a Malta holding company. The sole purpose of the holding company is to own the Malta licensed entity, being the next box under. That Malta holding company is not a regulated entity, it's a simple standard structured company. The Malta licensed entity in itself, as the name implies, will be, for example, the AIFM, so one will need to apply with a local regulator to obtain an AIFM license. But essentially the Malta licensed entity will have an agreement with the fund, the standard investment management agreement, whereby fees will flow into the Malta licensed entity. So for a typical hedge fund, 220% will flow into the Malta licensed entity. The Malta licensed entity itself will then possibly have a sub-investment management agreement with an underlying entity, depending where the CIO, the non-doms may be. So let's assume it's a UK entity, so an FCA MiFID entity. And the Malta licensed entity again will have a sub-investment management agreement with the FCA entity. That will allow for the Malta licensed entity to pass on fees to be able to pay for the UK entity to carry out its service. Now typically the services delegated would be portfolio management. One key aspect to mention here is that with the introduction of the AIFM directive, whereby an AIFM can only be licensed as an AIFM if it carries out portfolio management and risk management, that gives a lot of weighting to the two aspects thereon. So our typical structure in Malta is that the Malta licensed entity would keep the risk management aspect and it will delegate the portfolio management or part thereof to the FCA MiFID entity. All this will leave ultimately an element of fees and profits, if you wish, in the Malta licensed entity. The standard tax aspect to that is that, let's assume you have 100 euros in profits, one would need to pay 35% of those 100 euros, equivalent to obviously 35 euros, so it's a very high tax charge, and leaving 65 euros in distributable profits. On the assumption that the full 65 will be distributed to its owner, being the Malta holding company, the Malta holding company can then apply for and within 2 weeks get a rebate of 6/7 of the tax paid, equivalent to 30 of the 35 tax paid, leaving a net tax paid between the group in Malta of 5% or 5 euros in the case of the example. Other than the tax aspect, we mentioned previously there are other benefits for setting up in Malta. And there are two types of categories that we are seeing lately, also stemming from the Brexit discussions, but various others, including obviously the non-dom rule changes and how that impacts them. But let's assume the non-dom individuals, and let's assume it's the CIO or COO, are going to stay in the UK. So in the top section, for those not leaving the UK, It's not a problem because, as we mentioned in the previous slide, one can delegate the portfolio management to the UK entity, and hence the individuals can stay in the UK and carry out the same process they're doing today. Some of the benefits we've seen, though, is that investors tend to see this as better governance from a risk management perspective, given the pure segregation between the entities, whereby the Malta AIFM would withhold the risk management aspect and delegate the portfolio management to a separate entity. It's within the same group, but it's still a different structure. Others are that senior staff members of the manager, so not the non-dom himself, but senior staff members themselves, may wish to move out to Malta, and if they do, they can enjoy a significant tax benefit from a personal perspective, paying 15% tax. Then there's also the cost efficiency aspect that we mentioned, so renting offices in Malta and HR costs, so the salary of middle or back office employees or customer services type, are significantly less from the mainland and even more so than London. And lastly, also take into account the Remuneration Code, which will be for the next section, but essentially there's a big benefit there to take into consideration using Malta. Similarly, for any of the non-doms wishing to move away from the UK, and find a friendly jurisdiction, Malta again is within the EU. So portfolio managers can easily get a Malta residency here to be able to work and carry out their respective roles. They can hire analysts possibly to do most of the execution aspects, so they don't need to spend 365 days a year in Malta. So they can travel, do the research, depending on the strategy and all. Investors equally have easy access to Malta, and it's a nice place to visit. The cost efficiency are the same as we mentioned before, and just giving a bit of an example of the cost efficiency to hire a grad, the cost would typically be around 20,000 euros. We mentioned Brexit. Basically, there's a lot of news out there, obviously, on Brexit. It's round the corner from a decision perspective. And the question we just put out there is that if it is a concern, would setting up an AIFM outside of London be in one's mind, and hence would Malta possibly be one of those jurisdictions that one may consider? Obviously, Malta is an EU member state, like many others, so there are others to consider, but given the other areas we just mentioned, and those we'll mention in a second, like the remuneration aspect, it is one to possibly consider. I will hand over to Andrea to take us through the Remuneration Code.
Good afternoon, thank you, Adam. My name is Andrea Zarafa and I'm a partner at the law firm Ganado Advocates. In the next section, I wish to go through the remuneration principles as well as the ESMA guidance on remuneration arising from the Alternative Investment Fund Management Directive. The particular aspect of remuneration enshrined in the directive gives rise to certain principles and certain particular difficulties for fund managers which fit within a certain threshold above 100 million or above 1.25 billion, which we'll be looking into later on. The particular dimension of the ESMA guidance, on the other hand, extends the application of the remuneration principles in the directive also to delegates of the fund manager. And we will see how Malta tackled that aspect of the ESMA guidance. So the first thing to determine is what is remuneration. So remuneration in terms of EU legislation includes all forms of payments or benefits which are paid by the fund manager, any amount which is paid by the fund itself, including carried interest, any transfer of units or shares in the fund in exchange for any professional services rendered by identified staff of the fund manager, as well as fixed and variable payments. The fixed and variable payments could include monetary payments such as cash, shares or options, as well as non-monetary benefits such as discounts and fringe benefits. On the other hand, remuneration excludes dividends or similar distributions which are received by the owners of the fund manager, however, only if such distributions or dividends are not aimed at circumventing the remuneration rules in the directive. Following the definition, one would need to identify the scope of the principles. To whom would these remuneration principles apply? They apply to identified staff. These people would be members of the fund manager whose professional activities have a material impact on the risk profiles of the fund manager or the funds which are managed by the said fund manager. Identified staff in itself is a term which is included, which is defined in the directive. And this is defined as including, so this is not an exhaustive definition, executive and non-executive directors, senior managers, heads of business units, such as heads of the portfolio management, marketing, administration and HR units, certain control functions like risk managers and the compliance officer, any staff who exert a material influence on the risk profile of the fund or the fund manager, as well as staff which is remunerated in the same bracket as the risk takers. There are two specific requirements arising from the directive which relate to the requirement for the fund manager to set a remuneration policy, as well as to establish a remuneration committee. The remuneration policy in itself needs to comply with certain rules. So this policy would need to establish principles which are consistent with and promote the sound and effective risk management of the funds which are being managed, which does not encourage risk-taking, and should be in line with the business strategy, objectives, values and interests of the fund manager and the fund. It should also include measures to avoid conflicts of interest and must place responsibility for its implementation and periodic review on management. In fact, the implementation of the policy must be subject to an annual independent internal review, which would determine its compliance of the policy with all the policies for remuneration which are adopted by management. The policy would also need to include certain specific provisions on payments, on the manner in which staff can undertake personal hedging strategies or otherwise, as well as on any fixed and variable components of total remuneration which would need to be appropriately balanced between fixed and the variability of that remuneration. The second requirement, apart from having a policy, is for the fund manager to have a remuneration committee. This requirement applies only to those fund managers which are significant in size, which would need to establish a committee which typically in Malta is composed of at least, of a maximum of 3 individuals who would be approved by the MFSA without an extensive due diligence on these people unless they naturally occupy other positions within the fund manager, and who would need to meet regularly in order to review, revise and apply the policy which they would be setting on remuneration. One of the most contested possibly aspects on the remuneration sections in the directive relates to the proportionality of the fund manager and the manner in which these principles apply to which fund managers depending on their size as well as the assets which they manage. Indeed, in assessing proportionality, the fund manager should be focusing on a combination of criteria revolving around the size of that fund manager, its internal organization, as well as the nature, scope and complexity of its activities. The requirements of the directive relating to the payout process, as well as the requirement to establish a remuneration committee, may be disapplied on the basis of proportionality. In the next slide, we seek to split the applicability of the proportionality rules, as these apply to the remuneration principles, between fund managers which are managing funds which are subject to leverage, which apply leverage in their investment strategy, which is the top part of the slide, as opposed to those fund managers which manage assets which implement a strategy which is not leveraged. The main difference, which you will note between the two categories of fund managers, are the minimum thresholds as well as the maximum thresholds. So to give an example, a fund manager which is managing leveraged assets over 1.25 billion euro would need to apply the payout process, as well as would have to apply fully the ESMA guidelines. On the other hand, this threshold of 1.25 billion euro moves up to 6 billion euro, where the fund manager is managing unleveraged assets. The remuneration, or certain aspects of the remuneration, is also subject to disclosure requirements in the annual report of the relevant fund. So the information on remuneration paid by the fund manager to its staff would be disclosed in the annual report, which would need to specify the total remuneration paid to the manager's staff split between fixed and variable remuneration, the number of beneficiaries, and any carried interest which is paid by the fund manager. It would also need to disclose the aggregate amount attributable to risk takers and senior management of the fund manager. As indicated initially, one of the aspects tackled by the ESMA guidelines on remuneration related to delegation. So the ESMA guidelines establish that where the fund manager delegates the risk or portfolio management activities to a sub-manager or a risk manager, whether that sub-manager or risk manager is in or out of the EU, then the delegate would also be subject to the remuneration principles in the same way and to the same extent as the principal, as the entity, the fund manager delegating those functions. The ESMA guidelines adopted a comply or explain approach, in the sense that where regulators in the EU felt that they shouldn't be complying with one or more aspects of these guidelines, they had a right to do so to the extent that they provided an explanation to ESMA the basis for not complying with those aspects of the guidelines. The MFSA, hence Malta, adopted an approach where it was decided that the applicability of the remuneration principles to delegates would be disapplied. So, to bring an example of the consequences of this decision by the MFSA, a Malta domiciled fund manager would be subject, which is subject to the payout process and the remuneration committee establishment. Since it is above threshold for remuneration purposes, would therefore need to apply the full scope of the remuneration principles. Where this fund manager is delegating the risk or the portfolio management to a third-party entity, which could be in or outside of the EU, let's say the Maltese AIFM is delegating the portfolio management to a US-based fund manager, then that US-based fund manager, since the delegated fund AIFM is Maltese, would not need to apply the remuneration principles in the directive. Indeed, Malta is the only member state which adopted which decided not to adopt the look-through principle arising from the ESMA guidelines. moving on, that brings to an end the part on remuneration. We move on to a summary on fund vehicles which are available in Malta. There are 3 fund vehicles which one can set up under the Maltese regulatory framework. So from a regulatory perspective, one could have a UCITS fund, an alternative investment fund, or a professional investor fund. The UCITS fund is a retail fund. It can be passported across the EU and sold on a cross-border basis to retail investors. The alternative investment fund, on the other hand, can also be marketed across the EU so long as the fund manager is an EU AIFM and the fund, the AIF, is an EU AIF. In this case, we are proposing a Maltese domiciled AIF. Obviously, if one of these 2, EU AIFM, EU AIF, is not a fact, is not there, then the fund can still be marketed but solely on a private placement basis. But to benefit from the full passport, one would need to have both. So the AIFs in Malta are subject to licensing by the MFSA. We will come later on to notified AIFs, which are a particular subset. The next type of fund is the PIF, the Professional Investor Fund, which is a fund which is a locally based fund. It was locally created by the MFSA, which cannot be passported in the EU, and which can be managed by any fund manager so long as they are not AIFMs. So PIFs can be managed by sub-threshold or de minimis AIFMs. The structures themselves can be, there are several available. I'm here mentioning the main 4. So the type of fund can be then structured into either a SICAV, a limited partnership, or contract-based, or it can be fitted into a unit trust. It obviously depends on the investment strategy, which type of structure would be adopted. So a SICAV, which is an open-ended variable share capital company, is normally used where the strategy is either a hedge fund strategy or where the manager is allowing redemptions and subscriptions happening on an ongoing basis. Limited partnerships are, on the other hand, utilized where the fund manager would want to give a choice to investors between participating via shares or participating via participation rights. The Maltese Limited Partnership is very, very similar to a Channel Islands Limited Partnership. It has separate legal personality, it has a general partner, and it must have at least one limited partner. The general partner can itself be a limited liability company. On the other hand, the fund structure can also be based in contract, what we normally call a fund commune, where the fund manager and the trustee or the depository of the fund would establish the fund by a contract bilaterally entered into between them, with investors joining and making their investment into the fund by becoming a party to that contract. The unit trust, on the other hand, was used traditionally for real estate investments. It is there, it is on the statute book, it is rarely used today, but the main aspect of a unit trust, which is different to most of the corporate, well, to all the corporate structures, is that it does not have separate legal personality. So on that basis, it is similar to a contractually based fund. Funds in Malta can be self-managed or externally managed. They can also be set up in umbrella form, that is with sub-funds, which would be segregated patrimonies or on a standalone basis. Finally, my last point relates to the notified AIF. The notified AIF is a new form of AIF which would not be subject to licensing by the MFSA, which the MFSA issued a consultation on in April, and it is expected that by the end of June we will have a fully fledged framework which would allow AIFMs, which are based in an EU member state, to put together fund documentation, notify the fund to the MFSA with a statutory turnaround period of 10 business days to launch. We are expecting this new product to reduce, obviously, time to market. I would like to thank you today for attending for this webinar, and would like to hand over to Adam for the concluding remarks.
Very good. Thank you very much, Anne and Andrea. So we're doing quite well on time, although we started a couple of minutes late. So we're trying to jump straight into a couple of questions here. However, just before then, I'd like to just mention something about Cordium. Some of you already know us. We are a global firm across the US, UK, Malta and Hong Kong. We focus in asset management, startups all the way to global firms. We have our own software that has taken off quite well. And besides the regulatory compliance angle, we also focus on governance, risk management, and financial and regulatory reporting and tax services. One key aspect to mention for those of you listening in and others, possibly US as well, is a product we call CTAS, Cordium Total AIFM Solution. So we have done this already a number of times since the launch of AIFM, we can set up your firm for you. We can help you plan for what you need. We'll identify and help you recruit staff that you may need. We'll identify and help you sign on service providers. We'll also carry out the full risk management aspect of your AIFM, as well as the compliance, accounting and reporting to the MFSA. But the risk management angle is key, because as I mentioned before, as we all know, the AIFM directive requires you to have both risk management and portfolio management. And by us enabling the risk management aspect on your behalf through a secondment agreement, essentially, so you have your own employee as a risk function, depending on the size you may need more than one, that will enable your AIFM here in Malta, which may abide by the tax efficiency and cost efficiency over and above, but equally the remuneration aspect, so it will stop in Malta. But again, to allow your AIFM to delegate the portfolio management to yourselves wherever you are based, and hence having an AIFM in Malta seems to check all the boxes that are required to have cost efficiency, possibly tax efficiency, but definitely the EU passporting angle to enable you to approach EU investors. One other aspect to mention, finally, is that while we apply for your MFSA license and you wait for that license, you could essentially come through our hosted Mirabella firm. It's an AIFM, and essentially you can immediately start marketing and or managing your fund through Mirabella as a hosted AIFM, and as soon as you obtain your own AIFM license, you will immediately move on to your own AIFM seamlessly without any restrictions thereon. Thank you again for attending the conference. We will now very quickly, we kind of ran out of time, but jump to a couple of questions. And again, once again, thanks for asking these questions. Hand over back to Nicola.
Okay, the first question that's come in is for Adam. It's the question basically asking, how does Malta compare with other EU jurisdictions?
Very well, yeah. We typically get that question for most of individuals calling in. They always look into all the jurisdictions, which is only fair. I mentioned previously, so Malta has all the attributes that any EU member state will have, including EU passporting. But one key aspect, or two key aspects of Malta, is the cost aspect. The setup is pretty much the same across various jurisdictions, predominantly Luxembourg and Ireland. However, for a more complex structure, one you may not find an ear to listen to, and in Malta typically we're quite good at listening to complex structures. But if that's the case, the cost then for complex structures is significantly lower in Malta, because even if you look at, for example, not to pick on legal fees, but if you look on legal fees, the costs for legal fees here are less than the mainland. But more importantly, ongoing costs for running your fund or your manager for Malta, again, as I mentioned before, are significantly lower And hence, I think when looking from a business perspective with jurisdiction, please do take into account the ongoing cost, which is the biggest saving.
Okay, and the next question that's come in is for Anne. The question is, will all non-doms get to rebase their foreign assets on the 6th of April 2017?
The answer to that is quite simple. At the moment, it is no. It will only apply to individuals who are deemed domiciled under the 15 out of 20 years test on that date. I asked this question at a recent conference I attended with HMRC. They told me at the moment they have no plans to extend this to people who become deemed domiciled the following year.
Okay, thanks, Anne. The next question is for Andre. Can you elaborate more on the new Notified AIF regime?
Thank you. The Notified AIF regime, just to go back to what I was saying before, is only available, just to be very clear, to EU domiciled AIFMs. With an EU domiciled AIFM and a notified AIF, one would be able to passport that notified AIF in the EU. Now, the notified AIF regime will not replace the AIF regime which Malta already has. So a fund manager basically has a choice. He can either opt for an AIF which is fully licensed by the MFSA. In that case, the process to obtain the license could take a number of weeks. On the other hand, that same fund manager could decide to go for a notified AIF, in which case there should be a statutory period of 10 business days for MFSA to turn around the notification. From a tax point of view, there would be tax neutrality on both structures, so the notified AIF is not going to be taxed better or worse than a licensed AIF. From an AIFMD perspective, there is also total neutrality, because whether you are a notified AIF or an AIF, you still need to comply, or rather the AIFM still needs to comply with the full AIFM directive. However, the notified AIF would be faster to market. On the other hand, the MFSA has also made it very clear that while a notified AIF would not be subject to licensing, they would still need to know about it. They would still need to review it. They would still need to go through a process where that notified AIF would ultimately receive the go-ahead from the MFSA to be able to go to market. So this will not be an unlicensed structure which is simply notified on a need-to-know basis in view of the requirement arising from the directive that every AIFM needs to notify its member state of the fund which he is managing. It goes a bit beyond that. So it is more of a halfway house between a totally unregulated entity and a fully licensed one.
Thanks, Andre. The next question is for Anne. The question is, how can I lose deemed domicile?
As I said earlier, becoming deemed domicile is a test on how many years you are a resident. So the test will be 15 out of 20 tax years. So after April next year, you'll have to become non-resident for 5 complete tax years to lose your status.
Thanks, Anne. Our final question. Adam, how long does it take to get a license?
Very quick. No. Now, essentially, typically for an AIFM, it would take generally anywhere between 4 to 6 months. We've done it actually faster than that, but that's only once. The MFSA are currently looking at their processes, which is very encouraging, and true to the word that MFSA is pro-business, because they are one of the pillars for Malta to be able to keep us there from a jurisdiction, and hence we comfortably say that it's between 4 and 6 months, both for an AIFM as well as a full AIF. But as Andre mentioned before, for a notified AIF, it could be significantly less, and hence allowing want to start marketing immediately with the typical structure of having a notified date, and for example, there are others, Mirabel as a hosted platform, and while you market and you raise money and you get performance, then you can apply for your full AIFM and your full AIF and upgrade the notified to a full AIF, and hence business as usual. It doesn't fit everybody because it's very much dependent on investor appetites, but we'll happily get into that in a bit more detail outside of this call today.
Okay, that's all the questions we have time for today. If anybody has submitted a question, and I know several of you have, which has not been covered off, we'll take your question offline and respond directly. We'll also issue out the presentation slides to all the participants. I'd like to thank everyone for listening today and hope that you found this helpful and informative.